Welcome to Upticks with Jake Falcon, founder and CEO of Falcon Wealth Advisors. In this podcast, we help high net worth individuals overcome financial complexities. We do this by enhancing financial literacy and discussing topics in a language free from industry jargon. Join us as we help explain exactly what having a solid financial plan means, as Jake draws from years of experience in helping hundreds of individuals get financially organized and focused on their goals. We hope you find Upticks educational, entertaining, and shareable. Now, on to the show.
Welcome back to Upticks with Jake and Cory. Cory, welcome back to the show.
Jake, thanks for having me. Happy to be here.
You know, winter is rolling right through, Cory, and as of the recording of this episode, we've dodged a lot of the harshness. So do you think it's going to be a easy winter on us this year?
No, I don't.
Okay.
I feel like this happens every year in January and February is when it really turns on us. We'll see.
Yeah, so we'll see. We'll anchor down there. All right, good. Well, today we want to go through our headlines and hot topics in the investment and financial planning world. Cory, so why don't you kick us off?
All right, Jake. Money moves to make if you're expecting the Fed to lower interest rates. What have you got here?
Right. So I want to give a little backstory on this one, Cory. The Fed is all I've been talking about for the whole year. And if you're watching or listening to this, I'm assuming that you have been paying attention to what the Fed is doing as well. If you haven't, the Fed has raised interest rates rather dramatically in an effort to cool off the economy and slow down inflation and get the jobs, basically back in balance for a sustainable economy. As a result of that, Cory, banks that pay interest are finally catching up. So you can get good money in CDs, good money in cash on your savings accounts, or you should be. If you're not, you should be. And this article talked about, well, now what? Now the pundits are saying that the Fed is going to lower rates in 2024. Now what do you do? And here's my takeaways: is that many people have an exorbitant amount of money in cash, since now they can make a better return in their savings account or even a treasury bond than they did a couple years ago. But this is my point, Cory, and I want to hear what your thoughts are. They should be careful, because if or when the rates drop, then these people may be forced to reinvest their cash at much lower rates. And in the meantime, they could miss a stock market rally. And so, Cory, my point here is this is why we don't go to cash and try to time the market. So we haven't been telling our clients, get out of stocks and go into a money market fund paying 4% or go buy a treasury bond paying 5%. We have stuck with our asset allocation. But I wonder what your thoughts are, Cory. If we think the Fed may lower rates next year, what are you telling people they should do with their cash?
It's a good time to assess how much cash someone needs to have, first and foremost. I think the expectation around what interest rates will do next year, who knows? Because I remember at this time last year, there was a lot of expectations for what rates would do in 2023, and those didn't play out that way.
Didn't they say they were going to lower them this year?
Yes.
And they didn't lower them. So
yes,
you're right. You're absolutely right. So I like your
They raised
point.
them. They raised rates.
Right.
They didn't lower them.
And
yes.
I like your point. Let's revisit how much money you should have in cash. Do you need a safety net for emergencies? Do you need safety net if you lose your job? Do you have a big purchase coming up? That's why you should have cash, but you shouldn't be playing this game thinking that you're going to make 5% and that's going to be better than the stock market. That's not what we're suggesting people do. But I like what you said. Now's the time to evaluate. Anything else before we move on to the next headline? Good one.
No, I don't have anything else to add there.
Okay. Yeah.
We'll see what happens with interest rates next year.
That's right. And that's my point, is you can't bank on it. You don't know. All right. Our next one, 80% of this group of retiree millionaires have dangerous credit card debt.
Some surprising numbers in this. So there was a paper that was published by the Center for Retirement Research that showed that adults age 60 or over, Jake, hold 29% of the $1.08 trillion in credit card debt that Americans hold as of the third quarter this year. So of all that debt, 29% of it is held by adults 60 and over. But they actually talked in this article about what they have dubbed as wealthy spenders, which is people
Let's
that
talk
are
about that. Let's talk about this real
Yeah.
quick. So you're saying almost a third of all credit card debt
in the US.
in the United States is held by boomers.
Correct.
I didn't think that. Did you?
Neither did I.
Wow. That's excessive because we're very fortunate, or maybe our clients aren't telling us, but a lot of our clients have no credit card debt. And so a third almost. Wow. Okay, keep going. So what were you saying?
Yeah. So really, in addition to that, they because I was surprised by that also, Jake. But this paper that was published identified what they call wealthy spenders, which are people that are 65 and older with $1 million in assets, but are at risk of financial hardship. And they found that 80% of this group had credit card debt, or I'm sorry, 80% of this group had a second home. So a lot of the people that are basically holding credit card debt have second residences. And the credit card debt, with the average rate inching up to almost 21% now in the United States, basically saying despite the fact this group of people has $1 million in assets, they are at risk of financial hardship because of unresolved debt issues.
Interesting. So, we've got many clients that have second homes that may or may not have credit card debt, but I'm curious, I guess, are they implying then that people that have two homes have a spending problem? Is that what they're implying?
I guess that specific data point was one that I thought was interesting, but they really didn't elaborate on what that, I think that is, of course, if somebody has a second home, presumably that means they're going to have additional expenses, but I don't think that there's, direct correlation or tie between those two. What this article argued, Jake, and I thought I wanted to ask you about this, they said the psychological element is a big part of it. And basically that older folks they still want to treat family to meals, take family vacations, do the things that they've always done, even if it strains their finances, because they don't want adult children or other people in their family to think that they're not doing as well as the people in their family think that they should be doing.
Interesting, especially if they have $1 million, right?
Yep, exactly.
You think about it, if you've got $1, $2, $3, $5 million, you're supposed to be fine. So
Exactly.
Interesting. So they're probably still trying to keep up with the Joneses. They don't go around telling people they're on a fixed income because they don't want to advertise that they're not in great shape. So instead, they are stretching and rolling credit card balances. And that's interesting, Cory. Yeah,
You think there's validity to that?
Well, I think it's a case-by-case basis. I think there are people out there that are living outside their means and aren't managing their debt appropriately. Absolutely. It's a big problem in America. However, I think a lot of people that at least I work with that have second homes do manage it because they're managing two households here.
I know.
And that's not easy. I mean, you've got 2 electric bills, 2 water bills, 2 gas bills, 2 homes to insure or whatever. Like, you got a lot going on there.
Taxes.
Yeah. So I think that sadly, that's just an American or maybe even a humanity problem, depending on the society that you're in, that people overspend. That's why there's a retirement crisis in America. People haven't saved enough. And this is another example of that. But again, that's why there's more of a reason to have a wealth advisor as you lead up to retirement to get some of these things in order.
Yes.
And you have to have a little bit of a wake-up call and be honest with yourself and say, hey, I don't want to have $20,000 in credit card debt in retirement. So what do I need to do to change my behavior so that I don't have this issue the rest of my life? But it's not easy, Cory. It's not easy for everybody. So I get it.
No, it's not.
So good one.
All right. Which generation is most likely to make 2024 financial resolutions, Jake? Hint, it's not boomers.
It isn't.
What have you got here?
It isn't the boomers. Don't change the title, Cory.
It's not. It isn't. Fair enough.
So did you look at this or no? Can I get your guess or do you already know?
I didn't look at it.
What's your guess? If it's not, so again, 2024 financial resolutions, who do you think, what group or what generation do you think is most likely to make these?
Millennials or Gen Z, but I'm undecided on which one is more likely to make financial resolutions. I will guess millennials.
You're right. So 76% of millennials, and believe it or not, 75% of Gen Zers, so it's really both.
Okay.
And this is polled by Fidelity, say they are considering financial resolutions for 2024, compared with 66% of all respondents and just 53% of baby boomers. So credit to the baby boomers, right? Maybe they've got their finances in order. For Gen Xers, the figure was 66%. So here's my takeaway though, Cory, and I want to ask you this. First off, do you do New Year's resolutions? Personally? No, right?
No.
Neither do I. And we can have a whole nother conversation about that. But my next question is money something that should be a New Year's resolution?
No.
Right. It's health.
No, it shouldn't.
And a lot of
it should be an all-year resolution all the time.
Right. And what about health? So many people say, I want to exercise, I want to eat healthier. Should that be a New Year's resolution?
I want to be healthy next year. I want to have my finances in order next year. It's like, actually, the best time to do that would probably be today.
Right. So that's my argument, is that these should be fundamental. You don't have a New Year's resolution, Cory, that says, I'm going to start brushing my teeth.
Right. It's part of what I do every day.
Right. Or I'm going to tie my shoes, or I'm going to take a shower. Right. So as personal hygiene or dressing I'm going to wear a suit, like dressing yourself, how we make those so fundamental. My big hope is that we can learn to make health and finances a fundamental part of your routine. Like you said, it should be an everyday resolution. I like that. But it's scary. 3 out of 4 millennials are saying their New Year's resolution is going to be financially related. And 3 out of 4 Gen Zers. So the young people of America, I think, are finally starting to recognize, Cory, that they're behind. So many of these younger, technically I'm a millennial, but I don't identify. I'm really Gen X. I'm right on the edge there. You're a millennial, right?
Yeah, I'm firmly in the middle.
And I think a lot of these millennials out when they, graduated high school and graduated college, they came out more about, I want to take a lot of vacation and I want work-life balance and I don't care about money. But now they're starting to get mortgages. They're starting to have families. They're starting to pay taxes. They have some big boy and big girl responsibilities, and they've recognized that they haven't done a good job of that. And so my hope, Cory, through this show, and again, this show's more tilted towards retirement planning. However, if we can educate one person from Upticks on the fundamentals of managing your money, should be as routine as brushing your teeth, hopefully that makes our world a better place, right? So I thought that was fascinating, though. The 3 quarters, come on, that shouldn't be a New Year's resolution. What should be a New Year's resolution? If you and I don't really do them, what would be a good example, though? What's a good example of a New Year's resolution? I don't know. Do you have one?
I don't know. I've done them in the past, but I've learned that the whole point of the resolution, like, there's no sense in delaying what you want to improve.
Yeah. Maybe you want to read more. Maybe, I track how many books I read a year. I wouldn't call that a resolution, because I think some years I've read more or less. Maybe I don't think I read more books every year. So
yeah, I think charitable giving. I know someone that has that made a New Year's resolution to give more and to be, disciplined and structured about it.
So yeah, I agree. I can get behind the intention of wanting to self-improve,
Yes.
but I think self-improvement should be a 365 deal.
Nah, January. I'll start in January.
Start in January. All right, Cory, here we go. Interest rates are going to stay higher. 3 ways to benefit in retirement. So interesting. This flips our other article. Again, that's the point here, Cory, that nobody can predict it. So one article thinks they may be going lower. This one says rates are going to stay higher. 3 ways to benefit in retirement. What are your thoughts here?
Yeah, the market is returning to more normal conditions is the argument that they're making in this article. Basically, since what we have seen since the financial crisis in 2008, 2009 with really low interest rates, that was more of the anomaly than interest rates moving back to where they're at right now, for example. So that was the point of the article. What they really highlighted, was basically buying bonds to avoid reinvestment risk if interest rates are to decline, which I think is a great point. They talked about revisiting your portfolio to assess opportunities. I don't know if that's necessarily a way to benefit. Yes, I guess it is, but I felt like that was a little bit of a reach. And then lastly, they talked about, and I wanted to ask you about this one, Jake. I thought this was interesting. Raise your withdrawal rate. So the discussion here was around the 4% rule, which we've talked about on the show, and we do not subscribe to blanket rules like that being applicable to millions of people. However, they did talk about basically a fixed dollar amount or a percentage, like that 4% rule, versus someone that may tweak their cash flow or their allocation based upon market volatility. And the argument there was because interest rates are higher, you can safely raise your withdrawal rate. What do you think?
That. I don't like that. I don't like the 4%, like you said. I think that's way too cookie cutter. Life is too ambiguous for that type of rule. I think it always goes back to your target rate of return, and you're hitting it. Like for every one of our clients, Cory, that are retired, we have their target rate of return, and then we show if we're hopefully beating it or not. We show that, and then we show their withdrawal rate. And my point is, as long as their withdrawal rate is underneath their target rate of return or what we're making them, then their financial plan, in theory, should work. But I don't like adjusting your rate of return based on higher rates. The only way this would make sense, and this is why I don't like it, is are you going to go tell a client if and when rates do go down, now I got to cut, now we got to lower it because rates went down. I don't think that's a way to live life. I think again, you've got to blend it. You got to have stocks and bonds. You got to have an average return, and then you can smooth out those distributions versus, then really the Fed is dictating your quality of life. And I don't think that's a good way to spend 30 years, in my opinion.
I agree.
So
I agree completely. And I don't think, well, I know from meeting with enough clients over the last 13 years or so that most people don't want to have to completely adjust their lifestyle, to your point, Jake, in retirement based upon what's going on with interest rates.
Right. Do you have a chart in this one you want to talk about?
Yeah, I included this chart here that talked about basically buying power of $40,000 on $1 million portfolio. So kind of going back to the 4% rule. And the logic behind that is as inflation rises, stuff gets more expensive. So you can ultimately adjust that 4% based upon inflation. But ultimately, the takeaway from this article and raising that withdrawal rate is that is something that would be more applicable to someone who's not subscribing to the 4% rule.
Oh, interesting.
Basically saying if you're willing to give up the stability of predictable income in retirement, which I don't know a ton of people who are, but I'm sure I'm confident that there are some. They did make the argument that if you're willing to do that, then you can safely raise your withdrawal rate in light of higher interest rates.
Yeah, I don't think, I think that's.
The whole thing felt like a reach, really, the article. I thought the best point that they made was being mindful of bonds that you're buying and a bond ladder and reinvestment risk.
Yes, I agree.
And with that, Jake, a new era of income investing is turning boomers into bond buyers.
Yeah, we talked a lot about baby boomers this episode. And, I love the baby boomers, Cory. Most of our clients are baby boomers, or around that generation. And you can't deny, I don't care what a boomer tells you, Cory, you can't deny that they've had a good run. First, with the stock market rally during most of their careers. And now they're retired. And they can buy bonds at much higher rates than bonds have been in many years. So you and I have subscribed to buying bonds for a long time, but it's refreshing finally to see our clients getting a better return on that piece of the portfolio, because for years, Cory, our clients are only getting 2 or 3% onto their bonds. And so I just think credit to the boomers, Cory. They've gotten, we talked about this on other episodes, their homes have appreciated in value. Most of their careers, if they're investing in stocks, they had a great run in the stock market. And now they're retiring in waves. And look at this, you can de-risk and get 4 or 5% in something in a bond. That's, again, there is some risk, but certainly shouldn't be as risky as a stock if you're buying an investment grade bond. So I just like credit to the boomers. It worked out perfectly. And I don't know.
Maybe that's why they don't have financial resolutions.
Maybe not. And I don't know about the millennials. And now, again, I don't feel bad for any generation, but the millennials and the Gen Zers, we'll see. Gen X has kind of had a little bit of volatility, but Gen X has been okay too. So, but my point is these boomers, they're really benefiting now. And I think it's very important time to revisit a fixed income, like you just mentioned, and take a look at locking in some of those interests that you can get in bonds, and especially a treasury note or something. Why not? It's good.
Good.
All right, good. I think we've got time here for 2 more, Cory. So, okay. All right. So this first one is what the stock market taught us this year. Don't fall for these investing traps. All right, Cory, let's avoid some pitfalls.
There's 5 of them.
Oh,
The
great.
first one is don't Fed watch, which you talked about earlier, Jake. The point there being that if you invested in 2023 by watching the Fed like a tennis match and then reacting to every volley, you would continue to get it wrong.
Yeah, another quick point there, Cory. Don't fight the Fed. You got to roll with it, but don't change your investments based on what the Fed says. I like that one. What's number 2?
Don't buy the hype. They talked about the Magnificent Seven, which we've highlighted some on this show, that handful of stocks that have really driven a lot of returns this year. But through the end of October, 7 stocks have composed more than 30% of the S&P 500 and have contributed 87% of its returns. And they argued, we've seen this before, and the lesson is almost always the same. Winner takes all can dominate over shorter time frames, but it's rarely a winning bet in the long run. And at this point, the narrow market supremacy will end, and there will be a lot of other investment opportunities.
Yeah, so this goes along with meme stocks. This goes along with NFTs, maybe even, some would argue, maybe even crypto. And so don't get caught up in the hype. What's that? SPACs. We talked about last episode. You're exactly right, Cory. Don't get caught up in the hype. And I like that. Stay disciplined. What's number 3? There's 5, you said, or?
There's 5. Yep. Okay. The third one is don't anchor to the here and now. High, quote unquote, high interest rates here and now are much more in line with normal interest rate historically. The point being, don't draw major conclusions today for the next and extrapolate that over several decades, which is good.
Yeah, I say this a lot, that this too shall pass. So, yep, good.
Don't fear volatility. Ultimately, volatility presents opportunity, which I do agree with completely. And the point that they make is, although it may feel uncomfortable, where the most and best returns can come from is investing in the extremes, investing when there's panic, following a strategy and a discipline, and not being afraid of that volatility and running for the exits.
Right.
And lastly, number 5, Jake, was don't bet against America.
I like that one.
Compared to a lot of expectations for 2023 at the end of last year and where we stand right now, a lot of expectations have been defied. And despite everything that we see happening around the world and happening in our country, ultimately the same has continued to be true, in that the United States has been one of the best investment opportunities, and that's continued to hold true.
Yeah, and I think it's maybe a little domestic bias that we might have as citizens, that, we get frustrated with our presidents. We get frustrated with our tax code. We get frustrated with local governments. But you got to remember, this is a pretty cool place to live. And, I was watching Shark Tank last night. You ever watch that show?
Mm-hmm. Oh, yeah.
And they had these guys, I think they were from Korea, maybe. Yeah. Where's K-pop? That's South Korea? Probably
South Korea.
These guys were made like Korean barbecue, but they got emotional because, one of them, Cory, his parents brought him over here when he was I don't know how old he was, maybe school age boy, maybe elementary school or something. Said they were going on a 1 or 2 week vacation. And the last day, I think it was him and his brother, said, we're actually leaving you here in the land of opportunity because we think you'll have a better chance in life. And his parents went back and left him. Could you imagine? Hardcore. And I'm sure at the time this was obviously crazy and scary to him, right? But he said on the show that that was the best thing his parents ever could have done for him. Talk about it.
Did they get a deal on Shark Tank?
I probably should have been paying closer attention. After that, I was probably playing on my phone or something. So I don't remember. Maybe. I don't remember, though. I actually, I don't know. There was too many of them.
That's actually aside the point.
Right. So
it is.
So, right. I love it. Don't bet against America. Again, we can get fed up with some of the stuff that goes on here, but you got to remember, the grass isn't always greener, and it could be a lot worse. So.
Absolutely. Great article.
All right, good. And our last article today, Cory, is Apple makes security changes to protect users from iPhone thefts. What do you got here?
This is relevant for virtually everyone that I suppose that has an iPhone. And the Wall Street Journal has done some pretty extensive reporting on this throughout the course of the year that I've read and actually have shared with some people, that interestingly, literally watching someone punch their passcode into their iPhone, if someone is ultimately able to steal that iPhone and they know that person's passcode, that basically gets you into everything. And you can lock someone that owns the phone out of it, out of iCloud and everything. And this has been the Wall Street Journal documented how like this is very low tech, but it's become a very effective way that basically people have stolen identities, stolen resources, stolen dollars, et cetera, is watching somebody put in their passcode
Really?
and then getting their hands on their phone. Yes, because it unlocks every app. If your Face ID doesn't work, you punch in your passcode. And what they're rolling out with the new software update here in the near future is a basically stolen device protection that will help to prevent that from being an issue. And the reason I wanted to mention this on the show is because I expect we'll probably all hear more about this, but it will be something that people will have to turn on and opt into. But the idea is it's going to have there will be a lot built into it to prevent this from happening. Like if somebody were to get their hands on, go ahead.
Hold on. How do I report my phone is stolen if I don't have my phone?
Through iCloud. If you have a computer, if you have someone else's phone, but
I don't
also
have a computer.
Jake, here's the thing though, it will use GPS and location. So if you, for example, Jake, if you're at home and at the office a lot, and that's where your phone is at, but your phone ends up somewhere else and someone is trying to get into apps, there's going to be basically ways to lock it down so people can't access everything. They're just rolling this out. It's new.
I don't know.
We'll learn more about it, but I think it's good that they've done this because it is a bit frightening to think about the fact that somebody gets your passcode in your phone, they can get into everything and they can lock you out.
You know what frustrates me is how dependent we are on our phones. I wish it would, and I'm all for advancement. I am. Technology, I love it, right? I am for it. But Cory, I'm a little bit older than you, and I grew up, people weren't on their phones all day.
They are now though, Jake. It doesn't matter how you grew up, is what I would say. And I'm being facetious,
No,
but like that's the point though.
You're right, but I don't like it. I don't like it. The big thing with me is watching too much television. Now, people could care less about the television. It's people on their phones. And it's just even watching TV, if you can do that with a group of people. I don't know, TV is still a lot simpler than all the crazy stuff you can get to on your phone. It's just, I don't know.
Worlds are in our pocket.
Yeah, it's crazy. So anyways, well, good. Well, thank you for sharing. And hopefully that does help with security, because obviously that's a big part of what we talk about is, cybersecurity and anti-money laundering. Like you want to be vigilant on that stuff. Protect yourself.
Yes.
Good. Well, thank you again, Cory, as always, for joining me. Thank you all for tuning in. Please like, subscribe, and share our content. And we hope all of you have a great week.
Thank you for listening to Upticks. Click the subscribe button to be notified when new episodes become available. Also, be sure to visit our website, falconwealthadvisors.com, and click the Contact Us button if you'd like to meet with Jake and his team.